right now, somewhere in a rusted out used trailer, sitting behind a manufacturing plant, there's a team of engineers in grease-stained shirts.
Right, definitely covered in grease.
Yeah, and they are quietly assembling a piece of hardware that is going to keep billions of dollars worth of NATO drones from, literally falling out of the sky.
It's just an incredible image.
It really is. Because, forget the flashy consumer tech keynotes, right? Forget the CEOs in the black turtlenecks talking about the next software update or some new virtual reality headset.
Exactly. While everyone is staring at their screens, the actual literal blueprint for the future is being built in this very unglamorous, gritty world of heavy physical infrastructure.
It's a massive disconnect.
It is a profound disconnect in how we view the modern economy. We are, entirely captivated by the digital interface, but we completely ignore the massive physical foundation that makes that digital interface possible.
The nuts and bolts of it all.
Right. The real tectonic shifts aren't happening in the software layer. They're happening in factories, in global supply chains, and in advanced material science. That's what allows those software companies to operate in the first place.
Which brings us to our mission for today's deep dive. We are looking at the Q2 2026 earnings call for a company called AMETEK, ticker symbol AME.
A fascinating company to dig into.
Yeah, because if you just glance at their corporate profile, they look like a traditional, maybe even slightly boring industrial conglomerate.
Very under the radar.
Completely. But if you actually dig into the reality of their operations, you realize this juggernaut is quietly building the physical layer of the future, the literal precision optics and thermal cooling systems for the world's most explosive secular trends.
From the hyperscaler AI build-out to, global defense modernization.
Exactly. So if you're the kind of person who wants to know what's physically being built to support the AI boom, or how massive global defense shifts actually hit a corporate bottom line, this deep dive is custom tailored for you. Okay, let's unpack this. We have to start with what I can only describe as an absolute sledgehammer of a quarter.
Sledgehammer is definitely the appropriate term here. In corporate finance, you rarely see an established industrial manufacturer post numbers this aggressive across the board.
Let's talk scale.
Right, so we are looking at record second quarter sales of $2.04 billion.
Wow.
Yeah, that is a 15% increase year over year. But the aggregate number isn't even the most important part. It's the composition of that 15% growth that demands attention.
Because 10% of that was organic growth and 5% was from acquisitions. And I really want to pause on this distinction because it's something that gets, glossed over constantly in financial media.
It really does.
A lot of conglomerates grow purely by taking out their checkbook, right? They buy another company, slap the revenues together, and claim they grew.
Which is just financial engineering.
Exactly. I look at that like an airline claiming their planes are faster just because they bought a second airplane. Sure, you have more capacity, but the underlying engine hasn't improved at all.
That is a highly accurate way to frame it. Growth by acquisition is simply buying revenue. It's an external addition. Organic growth, on the other hand, means upgrading the engine mid-flight.
Baking the cake from scratch versus buying the bakery.
Perfect analogy, yes. It means your core, pre-existing businesses, the factories you already own, are experiencing massive unprompted demand from the market.
And 10% organic is huge for this sector.
Right. For a heavy industrial company to achieve a 10% organic growth rate, it means their fundamental technology is suddenly in absolute structural demand. AMETEK is successfully doing both simultaneously, which is incredibly rare.
And the numbers get even crazier when you look past the current sales and look at future demand. They reported record EPS earnings per share of $2.09, which was up 17%, beating their own guidance of $1.96 to $2.
A massive beat.
But the orders, they had record orders of $2.3 billion, up 28%. And organic orders were up a massive 25%.
Which is staggering.
A 25% jump in organic orders for physical hardware is an avalanche. It means customers are breaking down the doors. And it led to a record backlog of $4.11 billion.
That backlog provides so much safety.
But as part of this, they threw out a very specific manufacturing metric that I want you to translate for us. They said they had a book-to-bill ratio of 1.12. Break that down. What does that ratio actually measure?
So the book-to-bill ratio is one of the most elegant, transparent metrics in the manufacturing world. It strips away all the accounting noise.
Okay.
Book refers to the new orders you have officially booked. Bill refers to the finished products you have shipped out the door and billed the customer for. So if your ratio is exactly 1.0, it means for every $1 of product you ship, you take in exactly $1 of new orders. You are perfectly treading water.
You're replacing your backlog at the exact speed you're depleting it.
Precisely. If the ratio drops below 1.0, you have a structural problem. It means you are shipping faster than you are selling.
And you eventually run out of work.
Right, your factories go idle.
Yeah.
But a ratio of 1.1 hub means that for every single dollar of hardware AMETEK ships out the door, they are receiving $1.12 in new firm orders.
So they are taking on new business 12% faster than they can actually make the stuff.
Exactly. And this isn't because their manufacturing is slow. It's because the demand curve is almost vertical right now.
That perfectly explains how a $4.11 billion backlog accumulates. But I want to push back on something here regarding cash. Their CFO talked about free cash flow, which was up 37% to $452 million.
A very strong number.
And he bragged about a, quote, free cash flow to net income conversion rate of 111%. Now, I know net income is an accounting metric and free cash flow is the actual tangible cash left over. But if they're converting at 111%, are they just artificially juicing their cash by chronically underinvesting?
You mean by deferring maintenance?
Yeah, because anyone can generate cash if they just stop fixing their machines and stop buying new equipment, right?
That is the exact right question to ask, because a conversion rate over 100% can definitely be a red flag for deferred maintenance.
Right.
However, in this case, the mechanism driving that 111% conversion isn't underinvestment. It is elite working capital management. They noted that their operating working capital improved by 220 basis points, dropping to just 16.4% of sales.
Hold on, let's untangle the jargon there. Basis points, working capital. Translate what a 220 basis point improvement actually looks like on a physical factory floor.
Sure. 1 basis point is 1/100th of 1%. So an improvement of 220 basis points means they reduced their working capital requirements by 2.2% as a proportion of their total sales.
Okay.
Working capital in a physical manufacturing environment is mostly inventory. It is the raw metal, the unfinished copper wire, the specialized plastics just sitting on shelves waiting to be turned into products.
So it's literally just stuff sitting around.
Right. If a company is poorly managed, you will walk onto their factory floor and see millions of dollars of half-finished components just gathering dust. That is trapped cash.
Because you already paid the supplier for the raw metal, but you can't bill the customer until it's a finished product. So the cash is literally just sitting there on a pallet.
Exactly. AMETEK improved this by 2.2% on a massive multi-billion-dollar revenue base. And they did it through ruthless inventory discipline.
Just-in-time manufacturing.
Highly advanced just-in-time manufacturing. They don't buy the raw materials until the exact moment they need them on the assembly line, and the moment the product is finished, it is on a truck to the customer.
Wow.
When you operate with that level of physical precision, cash doesn't get trapped inside your factories. It flows directly, unimpeded, onto your balance sheet. That is how you hit a 111% conversion rate without starving your business.
Okay, that makes complete sense. The operational discipline is very real, but numbers and ratios are just the scoreboard, right? They tell us the company is winning, but they don't tell us how they're scoring the points in the real world.
We have to look at the hardware.
Exactly. To understand the mechanism behind this growth, we have to look at the actual physical things they are selling. And that immediately pulls us into the biggest, loudest buzzword on the planet right now, artificial intelligence.
When the general public thinks of AI, they envision the software layer.
Chatbots, image generators.
Right. They think of chat interfaces and large language models. We interact with the software, so we assume the software is the entire industry.
But software is just code. It has to run on something physical. And this is where AMETEK's reality is so compelling. They don't write the large language models. They are selling the literal physical picks and shovels for the AI boom.
The foundational tools.
Yeah. In the operations discussion, they highlighted a business unit they own called Zygo, and they noted Zygo is crucial for the global AI build-out. How does a company most people have never heard of suddenly become a linchpin in the AI technology we use every day?
What's fascinating here is understanding the true physical bottleneck of artificial intelligence.
Okay, what is it?
The bottleneck is not software engineering. It is physical precision. To run an advanced AI model, you need incredibly advanced, dense semiconductor chips, specifically GPUs.
Right.
To manufacture one of these chips, you have to use a process called photolithography to print billions of microscopic transistors onto a perfectly flat silicon wafer.
And when you say microscopic, we need to be clear about the scale here. We are talking about dimensions measured in nanometers.
Yes, a nanometer is 1/1000th of a meter.
Which is almost impossible to visualize.
To give you a sense of scale, a single strand of human hair is about 80,000 to 100,000 nanometers wide. Modern AI chips are being etched with features that are 3 nanometers or even 2 nanometers wide.
That's practically at the atomic level.
At that scale, the margin for error is functionally zero. The mirrors and lenses used to focus the extreme ultraviolet light onto the silicon must be arguably the flattest, most perfect physical objects ever created by human beings.
Wow.
If a lens is off by a fraction of an atomic layer, the light scatters, the chip is ruined, and the entire multi-million-dollar manufacturing process fails.
So how do you even know if a mirror is that flat? I mean, you can't just run a ruler across it.
That is the science of metrology, and that is exactly what Zygo does. Zygo builds advanced interferometers.
Interferometers, okay.
They use lasers to measure the surface topology of these optical components and silicon wafers with absolute unyielding perfection. They map the surface at the sub-nanometer level.
So they are the quality control for the most complex manufacturing on Earth?
You literally cannot manufacture a next-generation AI chip if you cannot measure the physical surface of the silicon to ensure it is flawless. As the industry pushes for denser chips, Zygo's equipment shifts from being a useful tool to a non-negotiable requirement.
That is incredible.
Yeah.
They are at the very bedrock of the pyramid. If Zygo's lasers don't perfectly measure the mirror, the light doesn't focus, the silicon isn't etched, the AI chip fails, and the software never runs.
It all stops right there.
But the AI story doesn't stop at the microscopic level for them. There's a completely different end of the spectrum, which is macro infrastructure. They discussed another AMETEK business called RTDS Technologies.
Yes, a very different kind of scale.
And they mentioned RTDS recently received a massive order from, and this is an industry term, a data center hyperscaler. We're talking about a Microsoft, a Google, an Amazon, or a Meta.
The giants of the industry.
Yeah. Right. They received an order to help this hyperscaler de-risk the power profile of a broader data center buildup using real-time digital simulators. Why is a software tech giant buying power grid technology from an industrial manufacturer?
Because the reality of AI is that it is insatiably power hungry. We are witnessing a massive structural shift in how these technology giants operate their physical footprint.
How so?
Well, 10 years ago, a large data center might draw 20 or 30 megawatts of power. Today, a state-of-the-art AI data center demands hundreds of megawatts, and the next generation of facilities are being planned around a full gigawatt of power consumption.
A gigawatt. That is the power consumption of an entire mid-sized American city just to run a single building full of servers.
Exactly. And the tech giants have run into a brick wall. They've realized they can no longer just call up the local public utility and say, we're building a massive facility next month. We need a gigawatt of power. Please connect us to your substation.
The public grid can't handle that.
Not even close. The public electrical grid moves at a glacial pace. It's bogged down by regulatory approvals. It relies on aging infrastructure, and it simply was not designed to handle sudden, hyper-concentrated gigawatt loads.
So if you just plug it in...
If you plug a gigawatt data center into a standard local grid and turn it on, you could literally cause a brownout across the entire region.
Unbelievable.
So the hyperscalers are essentially being forced to bypass the public utility and build their own complex local microgrids, often incorporating dedicated natural gas plants, massive battery storage facilities, and local renewable generation.
They are essentially becoming their own independent utility company.
Out of sheer necessity, yes.
Yeah.
But here is the massive risk. Before you plug a billion-dollar AI data center into a brand new custom-built microgrid, you better be absolutely certain that the electrical current is perfectly stable.
Right, because if it's not...
A sudden spike or fluctuation in power, even for a millisecond, could fry hundreds of millions of dollars worth of advanced GPU servers, or take critical latency-sensitive AI applications offline globally. You cannot test this by just flipping the switch and hoping for the best.
So RTDS steps in to simulate it before they flip the switch. How does that simulation actually work?
RTDS provides what is known as hardware-in-the-loop simulation. They don't just run a software model on a laptop. They build physical simulation hardware that perfectly mimics the exact electrical dynamics, the grid inertia, and the voltage fluctuations of the proposed microgrid in real time.
Oh, wow. So it's a physical test.
Yes. Engineers can plug the actual physical controllers of the data center into the RTDS simulator. They can simulate a catastrophic battery failure, a sudden surge in compute load, or a grid disconnection and see exactly how the hardware responds.
They can completely de-risk the architecture before a single shovel of dirt is moved. So AMETEK's Electronic Instruments Group, which houses these businesses and hit $1.32 billion in sales with a massive 30.1% core operating margin, is clearly embedded in the physical reality of AI.
Deeply embedded.
But let me push back on this narrative for a second. Because I read the Q&A section of the transcript, and an analyst asked point blank how much of their business is directly tied to data centers. And management admitted that direct data center sales are actually a fairly small percentage of their total revenue.
That's true, they did say that.
So if AI is this massive driver and they are so crucial to it, why is their direct footprint in the data center so small?
It is a critical distinction that management had to clarify on the call. The differences between selling directly into the four walls of a data center building versus supplying the entire sprawling ecosystem that makes the existence of that data center possible in the first place.
Ah, okay. The blast radius of the technology.
Precisely. If you only look at the actual server racks, the cooling fans inside the building, and the direct components inside the data center itself, AMETEK's slice is relatively small.
Right.
But look at the massive industrial ecosystem required to build that one building. To populate the data center, you need AI chips. To get the chips, you need semiconductor fabs. To run the fabs, you need Zygo's nanometer metrology.
Yeah.
To power the data center, you need new energy infrastructure and microgrids. To test those microgrids, you need RTDS simulators. AMETEK isn't trying to sell a cheap plastic fan to go on a server rack.
Right, they're selling the foundational tools.
They are selling the highly engineered tools required by every single adjacent heavy industry that supports the AI boom. It is a much broader, much more insulated, and frankly, much higher margin way to play the trend.
That makes a lot of sense. They're selling the factory that makes the factory. But the reality of AMETEK is that they aren't just an AI derivative play. Because while all the media attention is focused on AI, there is an entirely different, quiet supercycle happening right above our heads.
Yes, in the skies.
Let's pivot and talk about their aerospace and defense business and this fascinating concept of non-discretionary demand.
The aerospace and defense, or A&D, segment of their business is showing remarkable resilience, reporting mid-teens organic sales growth.
Which is why.
In heavy industry, pulling mid-teens organic growth out of aerospace is incredibly difficult.
And it's being driven by what management is calling a commercial aerospace supercycle. They have an almost decade-long backlog. A decade.
It's unheard of.
If you are a major commercial airline right now, you are desperate for new, more fuel-efficient planes. The supply chain has been snarled for years, planes are aging out of fleets, and AMETEK is supplying mission-critical thermal management and power components for the new planes that Boeing and Airbus are frantically trying to build.
But while commercial aviation is a massive driver, the defense side of the business is where the actual cutting-edge engineering is happening.
Yeah, management highlighted that they secured 3 massive new UAV unmanned aerial vehicle, or drone programs, 1 for the United States military and 2 for key NATO allies.
The technological demands of modern drone warfare are staggering. AMETEK isn't making the plastic shell of the drone. They are providing the specialized, lightweight power distribution networks, the advanced fuel sensing systems, and critically, the electronics cooling solutions through their Rotron and PDT business units.
Because these drones are basically flying computers now.
You have to understand that a modern NATO drone is essentially a highly dense flying supercomputer. It is packed with radar, targeting sensors, and advanced processing units.
And when you pack that many electronics into a small sealed space, it generates a massive amount of heat, right?
Exactly. And you are operating this flying supercomputer in extreme environments, whether that is the blistering heat of a desert at low altitudes or the freezing thin air of the stratosphere.
That's a nightmare for electronics.
The thermodynamics are a massive engineering challenge. If you cannot effectively cool the electronics, the targeting systems fail, the radar shuts down, and the drone becomes useless.
Which brings me to what is arguably the most memorable and honestly hilarious moment in this entire transcript. They were talking about a new next-generation thermal management solution. It's called the MicroFoil heat exchanger.
Right, the new product line.
It is an ultra-low-weight, highly specialized piece of hardware designed to fit into the awkward, curved, conformal spaces of these advanced drones. This is absolute mission-critical, military-grade technology. And the CEO literally said on the call, "Congratulations to the used trailer team on this outstanding achievement."
The phrasing certainly stands out in a formal earnings call.
The used trailer team, I just love the juxtaposition. You have these massive tech companies building sleek, glass-walled campuses in Silicon Valley to design chat apps.
With their kombucha on tap.
Exactly. And meanwhile, somewhere in a rusted-out Airstream or a modular used trailer parked behind a manufacturing plant, a bunch of gritty engineers are pulling a multi-million-dollar state-of-the-art NATO drone cooling system out of a cardboard box. It perfectly strips away the corporate gloss.
It really grounds the narrative. It reminds investors that beneath all the high-level financial metrics, there are teams of specialized engineers solving incredibly complex physics problems in real-world environments.
Yeah.
But moving beyond the imagery of the used trailer, the CEO used a very specific financial term to describe the revenue coming from these defense and aerospace programs. He called it non-discretionary demand.
Let's unpack that.
We need to unpack why that specific phrase acts as a massive signal of strength to institutional investors.
Well, let's contrast it. Discretionary spending is optional. It's what happens when the economy is booming. A consumer decides to buy a new luxury car, or a corporation decides to upgrade all the office furniture in their headquarters.
Nice to haves.
Right. But the second inflation spikes, or a recession hits, or interest rates jump to 6%, that discretionary spending vanishes overnight. The consumer keeps their old car, the company keeps their old desks. Non-discretionary spending is the exact opposite.
Precisely. Non-discretionary means the purchase absolutely must be made, regardless of the macroeconomic environment.
It's mandatory.
When geopolitical tensions escalate across Eastern Europe or the Pacific, as they clearly have, national governments cannot wait out a high interest rate environment before they decide to modernize their missile defense systems or deploy next-generation drone fleets.
A four-star general doesn't care what the Federal Reserve is doing with interest rates. If they need the drone, they are buying the drone.
Exactly. The demand curve is completely decoupled from standard economic cycles. It is driven by national security priorities, geopolitical reality, and hard regulatory mandates like airlines being forced by the FAA to replace aging parts.
So it's recession-proof, basically.
It gives AMETEK's revenue a layer of extreme structural durability. If the broader economy enters a recession next year, AMETEK is largely insulated because their primary customers literally have no choice but to continue buying the exact hardware they are manufacturing.
So if we look at the board right now, they are perfectly positioned as the physical bedrock of the AI ecosystem. They are riding a decade-long commercial aerospace backlog, and their defense contracts are entirely non-discretionary.
It's an enviable position.
It paints a picture of a company where everything goes right. But we know business is never perfect. The true test of a corporate management team isn't how they steer the ship on a sunny day with a tailwind. It's how they operate when the storm hits and everything goes wrong.
Yes.
And that brings us to the turnaround of Paragon Medical, which is an absolute masterclass in the AMETEK growth model.
To understand the Paragon turnaround, we have to look at the broader segment it belongs to. AMETEK's Electromechanical Group, or EMG, saw an explosion in their core operating margins.
Yeah, they jumped up.
They expanded by 290 basis points, reaching an incredibly high 26.2%. The driving force behind this margin expansion was a business they recently acquired called Paragon Medical, which manufactures specialized orthopedics, surgical instruments, and drug delivery systems.
But the reality is this acquisition did not start well. Management was very transparent about this. Soon after AMETEK acquired Paragon, the timing proved to be disastrous.
It was a very tough macro environment for them.
They were hit by a massive pandemic-driven inventory destocking crisis. We need to explain what that actually means because it completely paralyzed the medical supply chain for a while.
The medical supply chain experienced a violent bullwhip effect during and immediately after the pandemic. During the crisis, hospitals frantically overordered every conceivable medical supply because supply lines were choked.
Everyone was hoarding.
Right. Once the crisis subsided and supply lines reopened, hospitals realized their storage closets were completely overflowing with inventory, so they just stopped ordering entirely.
They just lived off the supplies they had stockpiled in the basement.
Exactly. This is known as an inventory destocking crisis. The end consumer, the hospital, is still performing surgeries, but the manufacturer Paragon sees their new orders drop to near zero because the distributor is burning off excess inventory.
Which is terrifying if you just bought the company.
For a newly acquired business, seeing your revenue volume suddenly evaporate due to macro factors is a nightmare scenario.
If we connect this to the bigger picture of corporate management, a weak, inexperienced leadership team would have panicked in that moment.
Absolutely.
If revenue drops 30%, weak management immediately tries to protect the current quarter's profits. They slash research and development, they fire the specialized engineers, and they just try to survive the low volume period by cutting the actual muscle of the business.
But it's not how AMETEK operates. AMETEK used the quiet period, when factory volume was low and orders were sparse, to actually accelerate their internal integration activities.
They leaned into the storm.
They leaned out the cost structure, upgraded the internal systems, and deliberately absorbed what they refer to as integration friction.
Integration friction is a fascinating concept because when one massive corporation buys another company, it is never a clean process. It's incredibly messy.
Always.
You're ripping out their old IT and accounting software and forcing them onto your massive enterprise resource planning system. You're changing their HR policies. You might be physically relocating manufacturing lines from one factory to another. All of this disruption usually annoys the customer base, delays shipments, and depresses sales.
Yes. It is like trying to renovate a restaurant while you're still trying to serve dinner to a full dining room. It causes chaos.
Great analogy.
What AMETEK realized is that because the destocking crisis had emptied the dining room anyway, it was the perfect time to do the messy renovation.
Right.
They did all the heavy, disruptive structural integration while the market was already quiet. They optimized the supply chain, negotiated better sourcing agreements, and leaned out the entire cost structure.
And here is the aha moment of the entire earnings call for me. Because they did the gritty, unglamorous work of leaning out the business during the downturn. What happened when the hospitals finally worked through their stockpiles, the pandemic effects faded, and the medical volume finally returned to Paragon?
They achieved outsized, almost violent margin expansion. Because they had fundamentally lowered the cost structure of the business during the quiet period, when the revenue volume finally came back, it was flowing through a highly optimized, frictionless machine.
Management noted they were seeing 40% incrementals across the board.
It's incredible. Let's clearly define a 40% incremental margin because it demonstrates the pure leverage of an optimized business.
Okay, lay it out.
An incremental margin measures how much profit you make on the next dollar of revenue, independent of your existing baseline. If a company has a 40% incremental margin, it means that for every single additional dollar of new sales that comes in the door, 40 cents of that dollar bypasses all the fixed costs and drops as pure, unadulterated operating profit to the bottom line.
So 40 cents on the dollar is pure profit.
Yes. That is an incredibly high leverage rate for a physical manufacturing business. It proves that the underlying machinery of the business is highly optimized. Once your fixed costs are covered, every new order is wildly profitable.
But I have to ask, was this just a lucky bounce? I mean, did AMETEK just happen to buy a medtech company, suffer through a random pandemic destocked event, and then just ride the natural post-pandemic wave back up?
It's a fair skepticism.
Right. Anyone can look like a genius if the broader market just hands them a massive recovery. Is this really the relentless AMETEK growth model they pitched to Wall Street, or did they just get lucky?
It's absolutely the execution of their growth model, and the irrefutable proof is in their research and development spending during the crisis.
Okay, how so?
As we discussed, weak management cuts R&D when revenue drops. AMETEK, in the absolute depths of the destocking crisis, did not stop investing in Paragon's new product development. They kept funding the engineers. They kept designing new surgical tools.
So they were building new products for a market that wasn't even buying old products yet.
Precisely, because they knew that destocking was temporary. So when the hospitals finally started ordering again, Paragon wasn't just offering their old legacy catalog. They were launching brand new, highly advanced solutions in orthopedics and automated surgical technology.
I see.
The new product wins, the innovation that was funded during the dark days of the crisis, are what is driving their record growth right now. They didn't just ride a market wave, they engineered their own premium recovery.
Okay, so they have clearly mastered this operational playbook internally. They know exactly how to acquire a distressed or stagnant business, weather the macroeconomic storms, ruthlessly optimize the internal cost structure, and squeeze massive incremental margins out of it when volume returns.
They've done it over and over.
Which is incredibly important context because they are about to attempt to run that exact same playbook on a massive $5 billion external target. Let's talk about the elephant in the room, the pending acquisition of Indicor.
This is a monumental capital deployment, even for a company of AMETEK's size. They have signed an agreement for a $5 billion acquisition of Indicor, which they expect to close in the second half of 2026.
A $5 billion check is a massive swing. What exactly are they buying for that kind of money?
Indicor is a specialized industrial holding company that brings 10 different highly engineered business units under the AMETEK umbrella. But the specific metric that justified the $5 billion price tag, and the reason Wall Street is reacting so positively, is the revenue profile.
What's the profile?
Indicor boasts a highly attractive 50% recurring revenue stream.
Recurring revenue. That is the holy grail for an industrial company. It means you aren't just selling a pump or a sensor once and hoping the customer comes back in 5 years. You are selling the aftermarket parts, the maintenance contracts, the ongoing calibration services. It guarantees predictable, steady cash flow regardless of whether the broader economy goes into recession.
It's incredibly stable.
But dropping $5 billion in cash, I mean, we have to look at their balance sheet. Are they over-leveraging themselves? Are they putting the entire company at risk with a debt load that heavy?
They are not even remotely close to over-leveraged, and this loops perfectly back to that incredible free cash flow conversion we discussed at the very beginning of the show. Because they convert 111% of their net income into cold, hard cash, their balance sheet is a fortress.
A fortress, okay. Let's hear the numbers.
Management detailed their debt profile, and it is remarkably pristine. At the end of Q2, before this acquisition, their gross debt to EBITDA was just 0.8 times. Their net debt to EBITDA was 0.6 times.
Stop there for a second. EBITDA is one of those terms that finance people throw around constantly, but we need to define exactly what it means and why it's the standard yardstick for evaluating whether a company can afford an acquisition.
Sure. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. In plain English, it is a proxy for the raw core operating cash flow of the business before the accountants start applying tax strategies or factoring in the depreciation of old factory equipment. It tells you exactly how much raw cash the core business engine generates in a year.
Okay, so applying that to their debt.
So when we say their gross debt to EBITDA is 0.8 times, it means that if AMETEK took all the raw cash they generate in a single year, they could pay off every single dollar of their corporate debt in just over 9 months.
Just for context, in the industrial sector, a lot of companies operate perfectly comfortably at 2.5 or even 3.0 times debt to EBITDA. Private equity firms will sometimes lever a company up to 5 or 6 times.
Absolutely. Being under 1.0 times means their debt is essentially negligible relative to their raw earnings power. They have a completely under-leveraged balance sheet.
So they can easily afford the $5 billion.
Furthermore, they proactively secured their financing. They recently renewed a massive $3.5 billion revolving credit facility, pushing the maturity date all the way out to 2031, which locks in lower financing costs and guarantees liquidity.
That's a huge safety net.
The CFO specifically noted that even after they write the $5 billion check and close the Indicor deal, AMETEK will still have $2.5 billion in raw liquidity just sitting there, ready for the next acquisition.
It is just a massive, impenetrable war chest. But let's move past the financing and look at the actual operational mechanics. Once the paperwork is signed and they own Indicor, what do they actually do with it?
They run the playbook.
Right, because the CEO laid out a very specific synergy playbook to extract 10 to 12% cost synergies out of the acquired businesses. And this is where it gets really gritty and operational. He talked about global sourcing leverage, but the phrase that caught my ear was facility rationalization. And he specifically used this concept of a regional hotel.
Yes, the hotel strategy.
Explain the mechanics of this AMETEK hotel strategy.
This strategy is the absolute core of AMETEK's operational efficiency. Think about Indicor's current structure. They have 10 independent standalone business units. Left to their own devices, each of those 10 units is operating inefficiently on a global scale.
How so?
If all 10 units are selling products in Europe, they might each be renting their own independent office space in Germany. They each have their own receptionists, they each have their own IT server rooms, they each have a separate HR department processing payroll.
Oh, man. It is massively redundant overhead. You are paying for 10 office leases and 10 IT departments to accomplish the exact same administrative goals.
Highly redundant. AMETEK's playbook eliminates this instantly. They build one single, massive, world-class corporate facility in a region what the CEO refers to as a hotel.
Okay.
They go to those 10 Indicor business units, and they physically move all of their international sales, marketing, and service teams into this one shared building.
Consolidating the back end.
They maintain the independent branding and the specialized sales strategies of the 10 units. They don't mess with the customer-facing relationships, but they completely consolidate the underlying administrative infrastructure. AMETEK already has this global shared service hotel infrastructure actively running in places like India, Malaysia, Mexico, Serbia, and Poland.
I love this strategy. It is exactly like a real estate developer who goes into a historic neighborhood and buys 10 separate independent houses. Each of those houses has its own ancient, leaky, highly inefficient plumbing system and a broken boiler in the basement.
Perfect comparison.
The developer digs up the street, rips out all the old infrastructure, and connects all 10 houses to a brand new, centralized, hyper-efficient, state-of-the-art plumbing and heating grid. The houses still look exactly the same from the outside. The front doors haven't changed, the historic charm is preserved, the residents are happy, but the underlying property value, the margins, and the efficiency instantly skyrocket.
AMETEK is basically going to plug Indicor's 10 business units into their hyper-efficient centralized corporate plumbing grid.
That's brilliant.
That is how they achieve that 10 to 12% massive cost reduction without sacrificing a single ounce of the actual customer-facing quality or diluting the specialized engineering nature of the businesses they just bought. It is pure structural back-end optimization.
Okay, so buying outside innovation, stripping out the redundant costs, and optimizing the back end is a reliable, battle-tested, proven strategy for them. They've been doing it for decades. But here is where it gets really interesting.
This next part is crucial.
Because they aren't just relying on their checkbook to buy growth anymore. They are completely overhauling their internal speed, utilizing the exact same artificial intelligence technology they're helping to build. We talked about how they sell the picks and shovels to AI companies, but we have to look at how they are eating their own cooking. They are using AI internally to achieve something that sounds like an oxymoron. Software speed, physical manufacturing.
And this specific dynamic might be the single most consequential takeaway from the entire earnings call for long-term investors.
Why is that?
The CEO revealed that AMETEK didn't just dabble in AI, they have successfully finished a wave of 50 comprehensive internal AI pilot projects across the entire global enterprise. And they are already launching Wave 2.
And we need to be clear, these aren't just silly little chatbots to help HR answer questions about vacation days. He listed hardcore industrial use cases, right?
Very hardcore.
They are using AI for automating complex engineering document processing, predicting global supply chain delays before they happen, accelerating the massive due diligence required for multi-billion-dollar M&A targets, and enhancing the predictive maintenance software embedded directly in their physical hardware.
All highly impactful operational improvements.
But out of all of that, there was one blockbuster, mind-bending stat that jumped off the page for me. The CEO stated they are actively using AI to reduce the custom engineering design cycle for a specific product line from 1 full year down to 1 month.
Let's pause and truly deeply consider the profound competitive implications of shrinking a 12-month research and development cycle down to 30 days. We need to understand the mechanism of how this works and why it is so devastating to their competitors.
Walk us through the old way first.
Historically, if a customer came to an industrial manufacturer with a complex physical problem, say they need a highly specific, low-weight thermal management system for a brand new type of low Earth orbit satellite, the engineering process was brutally slow.
Because it requires humans manually drawing CAD models, debating the physics, ordering custom tooling, waiting weeks for the metal to arrive, physically building a prototype, putting it in a thermal chamber, testing it, watching it fail.
Then figuring out why it failed, redesigning it, ordering new tooling, and starting the entire physical loop over again. That physical loop takes 12 months.
Right. It's just iterative physical testing.
Exactly. But with advanced AI simulation, generative design algorithms, and predictive material science, AMETEK completely bypasses the physical loop.
Bypasses it entirely.
The AI can instantly generate thousands of potential design iterations. It can create a perfect digital twin of the thermal management system and subject it to simulated extreme temperatures, radiation, and stress in a virtual environment in a matter of hours.
That is wild.
The AI identifies the optimal design, predicts exactly how the materials will behave, and spits out the finalized blueprints. By the time they actually cut physical metal, they already know the product works perfectly.
And the competitive advantage of that speed is an absolute killer. I mean, if that satellite customer goes to AMETEK's competitor and the competitor says, we can engineer a custom prototype for you in 12 months, but AMETEK walks in and says, we used AI generative design, we simulated 10,000 variations last night, we have the perfect design optimized, and we can deliver the physical prototype in 30 days. The competition is effectively over before it even begins. It is an insurmountable moat.
It is game over. Speed becomes a weapon. And this intense focus on internal innovation is clearly paying massive dividends across the portfolio.
Yeah, the CEO brought up the Innovation Award.
He took time to highlight their AlphaSense business unit, which won the internal AMETEK Innovation Award. AlphaSense engineers successfully created the world's first galvanic lead-free oxygen sensor.
Why is a lead-free oxygen sensor a big deal?
Because global environmental regulations are becoming incredibly strict regarding heavy metals like lead. Original equipment manufacturers, or OEMs, are desperate to meet these new regulatory compliance standards, but they cannot afford to sacrifice the sensitivity or performance of the sensor.
So it's a regulatory mandate, meaning a technical hurdle.
Exactly. AlphaSense used their internal R&D to solve a massive materials science problem, giving their customers a completely compliant product without any performance degradation. And because of this relentless, accelerated innovation across all their divisions, their new product vitality metric is currently sitting at 25%.
New product vitality, meaning that a full 25%, 1/4 of their total global revenue is being generated by brand new products that did not even exist a few years ago.
Which is an exceptional software-like metric for a company that makes physical hardware.
Okay, but here is where I have to push back hard. I need you to untangle a massive paradox for me.
Let's hear it.
Because everything we are talking about, lead-free oxygen sensors, microscopic metrology lenses, aerospace heat exchangers, these are physical, heavy things. They require massive physical factories, specialized metal, and intense manufacturing processes, right?
Well, absolutely.
But the CEO noted on the call that AMETEK has a return on tangible capital of about 100%, and their total capital expenditures, the actual money they spend on building physical factories, expanding footprints, and buying heavy machines is only 2% of their total sales. It's about $160 million for the entire year.
It's a remarkably low number.
How on earth is an industrial, heavy hardware manufacturer operating with the capital lightness of a software company? How do you rapidly scale up physical production of these highly advanced parts without building massive, expensive new factories and pouring concrete every single year?
It seems entirely counterintuitive, doesn't it? The secret to this paradox lies in understanding exactly what AMETEK chooses to own and exactly what they choose to outsource.
Okay, lay it out for me.
AMETEK operates almost exclusively as an IP-driven niche mission-critical component supplier. IP, meaning intellectual property. They own the brains of the operation.
The blueprints.
They own the patents, the specialized engineering blueprints, the proprietary algorithms, and the knowledge of how to achieve microscopic tolerances. What they intentionally do not own are massive, low-margin metal stamping plants, basic foundries, or generic assembly lines.
So they aren't pouring concrete every time they get a massive new order for a drone cooling system.
Exactly. When you are the only company in the entire world that holds the patent for a specific galvanic lead-free oxygen sensor or a specialized sub-nanometer metrology lens for an EUV semiconductor fab, your value is entirely in the proprietary design and the highly specialized final assembly and calibration.
The genius level work.
You contract out the basic metal bending and the generic plastic molding to cheaper third-party suppliers. You just do the high-margin genius level final integration,
which requires way less physical factory space.
This hyper-capital light structure is what allows them to rapidly scale production up during boom times, or quickly scale it down during a crisis like the pandemic destocking, without being crushed by the massive, unyielding overhead of idle factories. They have engineered the nimble flexibility of a Silicon Valley software company, but they possess the physical permanence and the high barriers to entry of an industrial giant.
Okay, so let's quickly recap the board before we look at the future. We have core operating margins expanding significantly. We have custom engineering speeds shrinking from a year to a month using internal AI. We have a massive record-breaking $4.11 billion backlog.
Right.
And we have a balance sheet so pristine it can swallow a $5 billion acquisition of Indicor and still have $2.5 billion in raw liquidity left over. With all of these massive, undeniable tailwinds pushing them forward, what does management actually expect for the rest of 2026? How do they view the future?
It all comes down to guidance.
Which brings us to their forward outlook and navigating what the CEO beautifully referred to as AMETEK prudence.
Unsurprisingly, given the sheer strength of the first half of the year, management raised their full year 2026 guidance. They now expect overall sales to be up approximately 10% for the year.
Solid growth.
More importantly, they raised their EPS earnings per share guidance to a range of $8.20 to $8.30, which represents a highly robust 10 to 12% increase year over year.
Which is a very solid bump from their prior older guidance of $7.94 to $8.14. But during the Q&A section of the call, which is always where the most revealing moments happen, an analyst from Deutsche Bank pointed out a glaring discrepancy.
This was a great exchange.
For the upcoming third quarter specifically, AMETEK guided for sales to be up high single digits. The analyst basically got on the microphone and asked, hey, wait a minute, you just told us your organic orders grew by a staggering 25%. Your backlog is bursting. Why on earth are you only guiding for high single-digit revenue growth next quarter? Are you sandbagging the numbers?
And the CEO's response was incredibly telling about their corporate philosophy. He didn't deny it. He explicitly admitted there is a healthy layer of AMETEK prudence baked into those forward-looking numbers.
AMETEK prudence. I love that phrase so much. It is the ultimate corporate speak translation for we are under-promising so we can massively over-deliver.
It is the absolute hallmark of seasoned, elite corporate finance teams. If you are a CEO, you never ever want to set Wall Street's expectations so aggressively high that a minor unforeseen macroeconomic hiccup, a sudden supply chain delay, a localized labor strike, a currency fluctuation causes you to miss your numbers by a penny and absolutely punish your stock price.
You leave yourself a buffer.
By actively factoring in a layer of prudence, they're essentially guaranteeing to the market that they will at least meet, if not comfortably and aggressively beat, expectations when the quarter actually ends. Furthermore, the CEO pointed out a crucial stabilizing detail about that massive $4.11 billion backlog that completely justifies their confidence.
What was the detail?
He estimated that a full 80% of that backlog is firmly locked in and is scheduled to physically ship within the next 12 months.
That is an almost unheard of amount of visibility into the future.
Exactly. Think about how most companies operate. Most consumer discretionary companies, or even standard software companies, have to blindly guess what their revenue will look like 3 or 4 quarters from now based on hazy consumer sentiment surveys or broad economic forecasts.
If interest rates spike, their pipeline evaporates.
AMETEK does not have to guess. They already have the firm signed orders in hand for 80% of the entire next year's worth of work. They are heavily insulated from short-term macroeconomic shocks, inflation fears, or interest rate anxiety because their factory floors are already booked solid with a non-discretionary mission-critical infrastructure projects that their customers literally cannot cancel.
So what does this all mean? Let's try to pull all of these complex threads together. Over the last hour or so, we've taken a journey deep into the gritty, physical bowels of the modern industrial economy.
It's been quite a ride.
We started by looking at how they are supplying the literal nanometer-perfect picks, shovels, and complex gigawatt microgrid simulators for the hyperscaler AI boom. We looked at how the used trailer team is quietly outfitting highly advanced NATO drones and riding a decade-long commercial aerospace supercycle.
We examined their ruthless internal operational discipline, how they utilized a paralyzing pandemic destocking crisis at Paragon Medical to execute a masterclass on lean integration, hiding the friction, and generating 40% incremental margin expansion.
We saw how they are preparing to take a massive $5 billion acquisition in Indicor and plug those 10 independent and efficient business units into their hyper-efficient shared global hotel plumbing grid.
The playbook in action.
And perhaps most profoundly, we explored how they are aggressively utilizing internal artificial intelligence to completely shatter the traditional 12-month engineering cycle, allowing a heavy physical manufacturing business to operate at the blistering capital light speed of a software startup. AMETEK is proving quarter after quarter that while the flashy consumer software companies might completely dominate the evening news cycle and the social media feeds,
The real winners are elsewhere.
right, the real, enduring, highly profitable winners of this massive technological boom might just be the quiet, disciplined companies building the physical foundations beneath it all.
This raises an important question, one that extends far beyond just AMETEK and ripples out to the entire landscape of modern global industry.
What's the question?
As massive, exceptionally well-capitalized, highly disciplined conglomerates like AMETEK successfully deploy internal AI to compress a grueling one-year R&D engineering cycle into 30 days, what happens to their smaller, less capitalized competitors?
Wow, yeah.
Does the traditional concept of a slow-moving industrial moat completely disappear? Or does it morph into a violently uncatchable flywheel, where the giants of the industry simply move too fast, simulate designs too quickly, and optimize their physical supply chains too deeply for any mid-sized competitor to ever catch up?
That is a staggering, slightly terrifying thought to leave on. The industrial flywheel is spinning, and because of AI simulation and elite capital allocation, it is spinning faster every single day. Thank you so much for joining us on this deep dive into the hidden physical reality of the market. The next time you see a flashy consumer tech keynote or a CEO in a black turtleneck showing off a new app, I highly encourage you to take a second to look past the brightly lit stage, look past the slick software interface, and think about the microscopic optics, the gigawatt grid simulators, the advanced aerospace heat exchangers, and the incredibly complex, gritty physical layer quietly working in the background to make that digital future possible. We'll catch you on the next one.